Good evening, everyone. I am Nirav Savai from Hdfc Securities Equity Research. A very warm welcome to you all for Hdfc Securities webinar on top 21 research ideas which we recommend from a long-term point of view. Along with this talk ideas, this is FY21 and we are glad to inform you that Hdfc Securities has completed a very important landmark of 21 years of relentless and constant efforts directed towards value creation of our esteemed customers. Before I begin this presentation, I would like to state that the research ideas which we are sharing are all meant for long-term investment and one should look forward to accumulate them in tranches over a period of time. This can be either through a weekly, fortnightly, or a quarterly SIP. Now, why do we recommend an SIP and what are the benefits of doing it through SIP? By doing this SIP route, we expect these kind of investments can give a CAGR returns of 15 to 18% over next 3 to 5 years. We do SIP mainly because in the current prevailing market situation, particularly the post-COVID pandemic, Indian growth story has been facing multiple challenges, right from rising inflation of commodity prices to the stress on the financial side. Today, we are in the second wave of COVID pandemic. And if we see globally in developed countries, the trends which are emerging are clearly indicating that the second and the third wave is at least 2 times to 15 times more infectious than the first wave. In order to insulate ourselves from this volatility and to make sure the risk reward is favorable, we feel that accumulating in tranches is a better way to go ahead. For the year FY22, the nifty earnings growth of 30% is something which can come under threat if this COVID situation lingers for a longer period of time. We have prepared a list of 21 stocks across market capitalization and sectors, which we believe can give a good 15 to 20% SIP CAGR returns over next 3 to 5 years. We believe staggered buying is something where investors can benefit despite the ups and downs in markets over a period of time. Also, in order to simplify things, we have created a solution on our website, which is do it yourself or DSIP, where an investor can choose whichever stock they want to buy and automatically over a period of time, they can accumulate the stock in tranches. Now to begin with the stock ideas, the first company which we are recommending in this list is Reliance Industries. Reliance Industries is India's largest private sector company and one of the most diversified conglomerates in India, with presence across telecom, retail, and the entire value chain on the oil and gas side. We believe Reliance will comfortably be able to achieve zero net debt by FY22 following its rights issue and the mammoth capital infusion, which has happened by the stake sale of its consumer-facing businesses, mainly Reliance Digital and retail. Also, any meaningful progress on the Reliance OTC business with the Saudi Aramco deal can be further kicker and reinstate a positive view on the company. On the upstream business side, there's a large scalable opportunity. The KG-D6 gas fields are expected to be commissioned by FY23, which can contribute a 30 MMS CMD at peak level, which is equivalent to almost 15% of India's consumption demand. The stock is currently trading at about 9.6 times EV by EBITDA, and we expect the consolidated earnings of the company to grow at a CAGR of 25% for the next 2 years. Extreme volatility in crude prices and any steep decline in demand for petchem products or refining products can be a risk to our assumptions. The second company in the large cap space which we recommend is Infosys. Infosys is one of the leading and the most established player in position across geographies, verticals, and service lines. It has a total employee count of almost 260,000. The company has guided a 12 to 14% constant currency revenue growth for FY22. We believe company's new large deal wins of about $9.3 billion provides a strong visibility to achieve this guidance. Stock is currently trading at 23 times FY23 earnings with a 40% plus ROIC and a 4% plus free cash flow yield, which provides us a lot of comfort. On the risk side, pricing pressure, change in immigration norms, or appreciation of rupee can be a risk to our assumptions in short to medium term. The third company in the large cap space we recommend is Hindustan Unilever. Hindustan Unilever is one of the largest companies in the Indian FMCG space and has the most best positioned portfolio of brands across the entire spectrum of FMCG products. We believe HUL is a play on India consumption growth story. Even in adverse times when they have to take price hikes, the company has been able to take price hikes. At the same time, they have been gaining market share across categories. This clearly indicates the robustness of the brands which they have nurtured over the years. The stock is currently trading at about 54 times FY23 earnings, and we expect a 15% earnings growth over the next 2 years. Extreme volatility on the raw material side and prolonged slowdown in the economy can be some of the changes which can change our assumption in short to medium term. The fourth stock is again from the FMCG space, which is ITC. ITC is one of the largest players in the cigarette business and has a dominant market share of almost 77%. Over the years, the company has been constantly investing into a lot of synergic businesses like FMCG, paper packaging, and even hotels. The company has a strong cash of almost 36,000 crores in its balance sheet and has changed its dividend payout policy from 65% earlier to about 80 to 85% now. This translates into a dividend yield of more than 5%, which is highest in the entire FMCG universe in the large cap space. Also, in terms of valuation, this company is amongst the cheapest companies in the FMCG space, trading at about 15 times FY23 earnings. We expect the company to deliver a 13% earnings CAGR over the next 2 years. The fourth stock is on the private banking side, which is ICICI Bank. ICICI Bank, with the change in leadership, has cut out a clear focus of achieving superior ROEs through strong operational performance. The company has transformed itself from the leading corporate bank to one of the largest retail banks in India, and further, it has increased the granularity in its book. The bank is well capitalized, and we expect that this will cushion any asset quality shocks during the current prevailing pandemic. The stock is currently trading at a price to average book value of about 1.8 times FY23, and we expect the company on track to deliver a 1.8% ROA by FY23 on the back of expanding NIMs and normalization in credit cost. Prolonged economic slowdown and higher than expected asset quality can have an adverse impact on our assumption. The sixth stock is State Bank of India. State Bank of India has the most extensive branch network across India with 22,000 plus branches and is a leader on the retail advances side. Apart from the banking business, the company has unlocked a tremendous value through its subsidiary like SBI Life, SBI Cards, and also SBI AMC in the unlisted space is one of the leaders. SBI is fairly insulated from the liability side risk at the current juncture, given its expansive, granular deposit franchise and the government majority holding. Recent COVID pandemic has led to tremendous stress in the banking system, and we feel if this can continue, there will be some downward pressure in the short to medium term. However, we feel on a longer term, SBI would be one of the beneficiaries of consolidation because of its size and reach. Stock is currently trading at about 0.8 times price to average book value. The seventh stock in the large cap space is Larsen & Toubro. Larsen & Toubro is India's largest construction company and is a sector bellwether in the domestic industry. Its overall order book as on 9-month FY21 stood at about 331,000 crores. Despite the turbulent macroeconomic environment post the COVID era, the company has been able to garner almost 73,000 crores of new orders in the third quarter FY21, which clearly is a testimony of the strong and robust positioning of the business in the entire sector. The company is actively pursuing monetization of its non-core assets and thereby targeting to achieve an 18% ROE over the next 3 to 5 years, which further reinforces a positive view on the stock. The stock is currently trading at about 14.5 times EV by EBITDA, and we expect a 33% CAGR over the next 2 years. The next stock is Sun Pharma, and my colleague Atul will elaborate on detail on Sun Pharma. So Atul, over to you.
Thank you, Nirav, and good evening, everybody. I am Atul Karwa, research analyst at Hdfc Securities, and I will be taking you through the next set of stocks. The next stock on our list is Sun Pharma. Sun Pharma is the fourth largest specialty generic pharmaceutical company in the world. It has grown to become India's largest pharmaceutical company with a global revenue of around $4 billion. So the revenues of its key specialty products, which are Ilumya, Cequa, and Absorica, has now exceeded its pre-COVID levels, and the company has now shifted focus to generating returns from the products already launched, and incremental spend on R&D would be largely directed towards additional indications. In the domestic market, its domestic formulation business has delivered growth in line with or higher than the broader markets over the last few years, and the company is expected to continue to launch 15 to 20 products per quarter in the medium term. Some of the key risks could be the slower ramp up in specialty portfolio, delay in US FDA resolution of its Halol plant, and lower growth in the domestic market. The stock is currently trading at 24.5 times FY23 estimated earnings, and we are expecting its earnings to grow at a CAGR of 41% over FY21 to FY23. The next stock on our list is Hdfc Life Insurance. Hdfc Life is a joint venture between Hdfc Limited and Standard Life Aberdeen, which is a global investment company. It is one of India's leading life insurance companies, offering a range of individual and group insurance solutions. The company is focused on superior product mix, which provide a higher margin, like protection and savings related products. And the company's sustained persistency ratio indicate client service and quality of products offered, which are critical for long-term sustainability. Product innovation and launches, coupled with diversified distribution, is seen to keep business momentum healthy. Steady traction in individual term insurance and pickup in credit protect, which has reached almost 95% of pre-COVID levels, is likely to keep its VNB margins at 24 to 25%. Rising competition, especially via digital disruptors, could pose pricing and volume risk for the company. The stock is currently trading at 4.1 times consensus embedded value. The next stock on our list is Bajaj Auto. Bajaj Auto is the largest two-wheeler company in India and the largest two-wheeler and three-wheeler exporter from India. Bajaj Auto has become a dominant player in the premium two-wheeler segment with brands such as Dominar, Avenger, KTM, Husqvarna, and Triumph. Demand for premium two-wheelers have been growing at a faster rate in India. The management is pretty upbeat on export volumes and expects FY22 to be the best year for exports. Recently, it has signed a MOU with the government of Maharashtra to set up a new manufacturing facility for high-end motorcycles and electric vehicles at a proposed investment of Rs 650 crores. Nevertheless, the competition is increasing in the premium segment, and stress in its key geographies could pose risk for the company. The company currently trades at a PE of 17.8 of its FY23 estimated earnings. The next stock on our list is Dauber India. Dauber India is the world's largest Ayurvedic and natural healthcare company with a portfolio of around 250 herbal and Ayurvedic products. It is the fourth largest FMCG company in India. The management has taken many initiatives in the last 2 to 3 years in the form of new launches, sharp increase in advertisements, continued expansion in distribution, investment in technology and analytics, and cost-saving efforts, the effects of which are likely to be seen in the coming years. Dauber has delivered double-digit top-line growth in the past 2 to 3 years, unlike most of its peers. The outlook for international business, which forms 25% of its sales, is strong, and the management expects an improvement in operating margins as well. New products which have been launched now contribute around 5% of sales. We expect a earnings growth of 12.3% over FY21 to FY23, and the stock currently trades at 44 times of its FY23 estimated earnings. The 12th stock on our list is Tata Motors. Tata Motors is the leader in the domestic CV industry and has a strong product portfolio under the Jaguar Land Rover, which is one of the strongest brands in global luxury automobile segment. TML has been rationalizing cost under its JLR brand and has saved almost £6 billion over the last 12 to 18 months. Its market share in the domestic passenger vehicle industry has been improving and hovers around 8%. The company intends to take it to double digits, driven by both new launches as well as a sustained focus across electric vehicles. In the LCV space, it has launched new products to recapture its market share. The management had announced at its FY20 AGM to become a debt-free company by FY23. Currently, its debt stands at around rupees 55,000 crores. Delays in stake sale in its PV business and extended sluggish macro environment would negatively impact the company. The stock is currently trading at 12.8 times of its FY23 earnings. The next stock on our list is Mahindra & Mahindra. Mahindra & Mahindra is a mobility products and farm solutions provider and the flagship company of the Mahindra Group. In FY20, it was the third largest passenger vehicle company, second largest commercial vehicle company, and the largest tractor manufacturer in India. The growing population of India would require higher levels of farm mechanization, benefiting tractor sales of the company. It is targeting to increase its farm equipment revenues from overseas market to over 50% from 37% currently, and grow the domestic tractor market share from current 43% to 50%. It is also shutting down its loss-making entities and focusing on companies which have future potential to generate higher returns. In the passenger vehicle segment, it is planning to launch 2 new electric vehicles, 2 new SUVs, and upgrade 2 SUVs. Its LCV segment continues to remain strong. Risks pertaining to acquisition and investment in subsidiaries and joint ventures could impact its profitability. The stock is trading at 15.3 times of its FY23 estimated earnings. We expect a 12% CAGR growth in earnings over FY21 to FY23. The next stock on our list is Dr. Reddy's. DRL has a strong pending pipeline comprising of 89 ANDAs to NDAs. Pending ANDAs comprise a good mix of complex products across dosage forms. Recently, the Sputnik vaccine has been given emergency use approval in India. The vaccine would be manufactured by Dr. Reddy's in India and has the potential to add around 6 to 7 rupees to its earnings per share. Some key generics like Kuvan powder, Vascepa, and Pegfilgrastim biosimilar, which have meaningful sales, are likely to be launched in H1 of FY22. Management's sustained focus on cost rationalization, endeavor on simultaneous launches across geographies and segments, besides realignment of R&D spend towards to translate to strong business growth in coming years. We expect earning growth of 37% CAGR over FY21 to FY23. The stock currently trades at 23 times of its FY23 estimated earnings. For the next set of stocks, Harsh would take over.
Yeah, good evening, everyone. Thanks, Atul. I'll just quickly run through a final set of recommendations and the underlying investment themes. So first up, we have got a Maharatna PSU in GAIL India Limited. GAIL is the owner of the largest pipeline network in India. It has integrated all aspects of natural gas value chain, right from exploration and production to processing, transmission, distribution, and marketing. Besides gas infrastructure, the company has achieved strategic diversification into petrochemicals, telecom, and liquid hydrocarbons. It has a quasi-monopoly with mammoth 70% market share in natural gas transmission market in India. GAIL is also planning to invest around $6 billion to expand its pipeline grid and city gas distribution network to scale up its value-added portfolio. Now, volatility in gas prices and high regulatory interventions are concerns in this space. However, robust growth prospects for Indian gas demand and supply, government and policy advocacy favoring natural gas as a preferred choice of green fuel, and ongoing expansion will increase companies' ROE going forward and likely lead the re-rating in our opinion. Next up, we have got a very interesting pharma stock, in Aurobindo Pharma. Aurobindo Pharma manufactures generic formulations and active pharmaceutical ingredients or APIs. It derives around 90% of its revenues from international operations, with US contributing to over half of that. Now, delay in product approvals or change in regulatory landscapes are key risks as in any pharma stocks. However, Aurobindo has one of the best product approval rates and launch pipelines in US. Despite pricing pressure, the company is one of the few companies able to mitigate this risk due to continuous product launches and approvals. So strong growth outlook exists for US business. So company is also considering the demerger of its injectable business, which alone is estimated to be valued in upwards of $4 billion. And now this could hasten the value unlocking for shareholders. Also, they are growing to produce something like 500 million doses of COVID vaccine. And we all know COVID is here to stay at least for next couple of years. So this could be a real growth trigger. It's trading at 16 times its FY23 earnings and is amongst the most attractively valued mid-cap pharma stock. Next up, we have another PSU in NMDC. NMDC is India's largest iron ore producer and exporter, producing more than 35 million tons of iron ore. We expect the production to be ramped up to 40 million tons. While production is expected to fall by 15 to 18% in FY21, we expect a gradual pickup in FY22, followed by a very strong growth FY23 onwards, due to government's focus on infrastructure spending along with favorable export markets. Higher iron ore prices, as we are witnessing currently, and production ramp up will aid the profitability. With focus on growth and divestiture of unrated assets, stock which is trading at discount to its global peers looks a buy. Drop in demand or rise in export duties could be monitorable risks here. Next up, we have got one of the most well-known cement companies in ACC Limited. ACC is the oldest cement company in India with pan-India presence and installed capacity of over 33 million tons. Its greenfield expansion in Ameta and associated grinding units are on track, which will take the company's capacity to 39.3 million tons per annum by FY23, providing a very strong visibility of growth. While the pandemic-led lockdown will impact the demand for cement across the country near term, the government's increased spending and its strong focus on infrastructure development allows us to maintain a positive outlook for overall cement demand in the future, of which ACC is likely to be one of the biggest beneficiaries due to its widespread network. The stock is currently trading at EV by a bit of around 9. We expect a 7% CAGR revenue growth over next 3 years and double-digit growth in its earnings. Next, we have got another Maharatna PSU in HPCL. HPCL enjoys over 18% market share in India and has strong presence in refining and marketing of petroleum products across the country. It has been the best performing public oil marketing company with least market share loss in auto fuels amongst the peers in face of rising private competition. It expects to continue adding 1,000 plus retail outlets each fiscal over FY21 to FY25, which will help it to build a very steady market share. Gross marketing margins in its auto fuel business have grown at 14.7% CAGR over FY17 to FY20. It is also into lubricants. So lubes are one of the most profitable products in OMC portfolio. It has gained steady market share in the lubricants business since FY14. Prolonged lockdown can affect the demand for fuel. However, IEA expects strong pent-up demand in second half of calendar year 21 and 22 as the pandemic subsides. This should run down the current elevated auto fuel inventories. We expect GRMs should take support from accelerated refinery closures. Next, we recommend a power stock in Tata Power Corp. The reason is, so Tata Power is India's largest private independent power producer. Company's regulated distribution, transmission and generation business is amongst the most efficient in the country, which delivers steady growth and assured returns. So basically, its presence across different segments of sector provides a strong platform to mitigate the risk of slowdown in any one segment and helps in leveraging new opportunities in other segments. Mundra's resolution, along with balance sheet deleveraging, essentially redirects the cash flows to more predictable regulated business of power and distribution. Tata Power also plans to add 2 gigawatts of solar assets each year, eyeing 18 to 20% of addressable market. In our estimates, the debt to equity should fall to 1.3x by end of FY21 from 2.5x in FY20 with InvIT formed. PAT growth will largely be driven by interest cost savings, promoter fund infusion, divestment of non-core assets, and Mundra tariff resolution. This should facilitate a healthy growth in ROEs going forward. Lastly, we have got a mid-cap cement stock in Birlacop. Birlacop is one of the leading cement producers with 15.7 million tons capacity spread mainly across central, north, and eastern India. Over the last 4 years, the company has achieved an exemplary turnaround in its operations despite prevailing external challenges, which saw its EBITDA margin grow threefold in FY20. It will now focus on capacity expansion. So its plan is to expand its capacity to 25 million tons per annum by FY 2025 from currently 15.7 million tons. And also the focus is on reducing leverage. So concerns here are the unresolved dispute amongst the promoters, and also ambitious expansion plans can affect the return ratios in near terms. But at valuation of 5x EV by EBITDA, it's amongst the most reasonably priced cement stocks. And as I mentioned, given the tailwinds in cement sector, this looks a formidable bet. So with this, we complete our set of recommendations and we can have a Q&A session perhaps. I'll hand over to Nirav. Nirav, if you can take forward.
Yeah, thanks, Harsh. We can open the floor for question and answer, please.
Dear participants, to ask any questions, please click on the question mark on your screen and type in your questions. I repeat, please click on the question mark icon on your screen and type in your questions.
Also, further, in the interest of time, we would like to restrict the questions only to the 21 companies which we have presented right now. So would be a pleasure to answer those questions, please. So there's a question on can we get this document? So it's uploaded on a website, and whomsoever wants to see the detailed rationale of these companies can just have a look at it. It's available on our website. So that's again another question. Can I have a text of all these 21 stocks? Now that's again something which is available on website. We can have a detailed overview of the investment rationale and the key triggers why we are recommending it. Another question, HDFC Life and Ergo are both the same companies. So both are different companies. HDFC Life is into life insurance, Ergo is into general insurance. It's an unlisted company. There's a question, which one is better in the pharma space, Sun Pharma or Aurobindo? Which is better for SIP for next 1 year? So we would recommend both of them are good. Obviously, Sun Pharma has its own set of problems and challenges why it has underperformed for a very long time. And now we see that, what has happened in the pharma space. There is a lot of price erosion which has already happened in last 3-4 years. And we see the prices are getting stabilized now. With this new government in US, can there be a change in their policy towards generics is something to watch out for. Aurobindo has its own levers for growth. So we recommend both of them are equally good. And if somebody wants to buy and have a diversified approach as far as the pharma sector is concerned. There's a question on can I buy Reliance Industries at CMP? Now, yes, there are multiple levers for growth for Reliance Industries. In fact, in this COVID era, digitalization is something which is the largest theme which is going on, and Reliance being one of the largest digital startups in India is tend to benefit. Again, the kind of investors which have joined this company are the likes of Google, Facebook. Obviously, there will be a lot of things which will come from the Western world from those investors in India, which will be done by Reliance in the digital business. Also, this year in FY22 onwards, we see improvement in the refining margin in the petchem space. From FY23 onwards, we see a lot of traction in the gas business. So this is a 3 to 5 year story. In the midst of this, there will be volatility, and that's one of the reasons why we have been constantly recommending the one to have a staggered portfolio buy approach. And Reliance also is a good fit in that space, irrespective of the price movement, what has happened in last 1 year. So how about Tata Motors? Atul, would you like to throw some light on Tata Motors, please?
Yes. Tata Motors basically it is looking to hive off its passenger vehicle business, looking to reduce its debt. Its JLR business is performing very well, and with all the infrastructure spending coming on, its CV business is also expected to improve significantly. We have already seen it gaining market share in the passenger vehicle segment with its latest launches, and its electric vehicle is also doing well. So overall, Tata Motors has multiple levers from here, so we can buy it in a staggered manner.
Thanks, Atul. There's a question on what is the duration of SIP. As we said, it's 3 to 5 years, and we expect there can be about 15 to 18 or even a 20% kind of a SIP CAGR returns over a period of that time. So again, there's a question of what is an expected time frame. So 3 to 5 years is something what we have been recommending. Do we have to invest manually one by one, or these can be done through a basket of 21 shares where we can invest directly 6, if any? That's how. So on our website, if you log into our website, we have a simple solution whereby either you can select a stock, you want to buy 1, 2, 3, 4, you can do it, and automatically over a period of time it will get bought. Also at the same time, you can buy a basket as well. So there's a question of what is a percentage allocation you recommend in these stocks. Now, we would make it very clear that one should not be biased on any of them and should be equally invested on each of them as far as the investment plan is concerned. You know, either you do it on a weekly, fortnightly, monthly, or a quarterly basis, but make sure that investment goes in the equal proportion. First missed initially first 10 stocks. So that's there, can get a detailed PDF on our website, all the 21 stocks together. Yeah, so any more questions, please, if you can provide some answers. There's another question. Could see many high-profile stocks like Hdfc Bank missing from these 21 stocks, and so I want to understand the analysis. How do you arrive at these 21 stocks? So as I said that we have a multi-sector and a multi-market capitalization approach, and out of these 21 stocks, there are few key parameters which we feel are the key growth drivers for the company. One is the balance sheet quality. Second is the way the company is positioned in the entire industry. The third thing is the kind of growth which we foresee in next 3 to 5 years. Fourth thing is at what valuation it is trading. And the fifth thing is what has been the historical trend in terms of promoter track record. And is there, have they been investor friendly in terms of generating wealth? So these are the broad themes which we have chosen before selecting the stock. And why not HDFC Bank? Being a parent company, we do not endorse any view on the company. as per our compliance issues. Yes, so there are no further questions. We would like to wait for a few more minutes in case if there is something. Yeah, so since there are no further questions, we would like to end this session here. Appreciate your presence and your time. Thank you very much for joining. It's been a pleasure answering all your questions and discussing these talks in detail. Thank you very much.
Thank you, everyone.